We have discussed enough about the advantages of passive investing. We also discussed what ETFs and index funds are. If you want to know more about them, refer to my video. Now comes the million-dollar question. How do I select an ETF or index fund? Well, there are no hard and fast rules, but there are definitely some guidelines. Let's talk about ETFs. ETF means Exchange Traded Fund, which tries to be a carbon copy of the index and is traded on the exchange just like stocks. I have included a list of all the ETFs traded on NSE and BSE. The ETF industry in India is not mature enough compared to developed countries. So while buying ETFs, we have to check the liquidity. If an ETF is having good liquidity, it means there are more people actively buying and selling the ETF units. And hence, in case you would like to exit and sell your ETF units, there are buyers readily available and hence you will not have any problem. On the other hand, if the liquidity of that particular ETF is low, there are not many buyers available when you want to sell the units and hence your sell order may not be executed. Let's understand how to know the liquidity of an ETF. Let's quickly go to NSE website and look for an ETF. Nifty BEES, which is an ETF by Nippon and tracks Nifty 50 index. The traded volume is around 6 lakhs, which is good. Traded volume just means how many shares of this ETF are traded on that particular day. Simple. Let's look at one more ETF in the same category, SBI ETF Nifty 50. The traded volume is around 1 lakh. This means Nippon Nifty BEES ETF has more liquidity than SBI Nifty ETF, which means more people are into it and you may not have problems selling your units in future. The second point to look is the tracking error. What's a tracking error? Tracking error tells us how close the returns given by this ETF match with the returns of the index it is based on. What I mean to say is, we know that this particular ETF has the same constituents or same stocks as Nifty 50 index, which means it tries to give the same returns as Nifty 50 index, right? But is it really closely and exactly following the index? How good is it in mimicking the index? If it closely follows the index, it will give the same returns as the index, and there would be very less difference in the returns given by this ETF and the index. This difference between the returns given by ETF and the returns given by index is represented by tracking error. So if the tracking error is higher, it means the returns given by this ETF are not close to the returns given by the index. On the other hand, if the tracking error is lower, it means this ETF is very close in performance to the index. Let's compare the same two ETFs, Nippon Nifty BEES and SBI Nifty 50 ETF. Let's go to Ticker Tape website and look for Nippon Nifty BEES. The tracking error is 0.03%. Let's see SBI Nifty ETF. It has a tracking error of 1.58%. So clearly Nippon Nifty BEES has a low tracking error, which means it is doing a good job of following the index. Another point to see is the expense ratio. Think of expense ratio as simply the fee or the charge that the fund company charges you for managing your funds. Naturally, we prefer lesser charges and hence lesser the expense ratio, the better it is. You can also compare these parameters with those of its peers, that means the other ETFs in the same category. Another point to consider is when the fund was launched, the history and any other news or events associated with the fund. Let's consider Nippon Nifty BEES and look when it was launched. It was launched in 2002. If you consider SBI Nifty ETF, it was launched very recently in 2015. Personally, I do not like the funds which are launched new. They may charge very less in the beginning to lure investors but may raise the charges later, which is a bad practice. And another personal suggestion, this is my personal opinion though, people may have different and better experiences. It's up to them. I don't prefer sector specific and theme based ETFs. So when it comes to choosing an ETF, we should give more preference to the history of the fund, its liquidity, expense ratio and tracking error, and try to achieve a sweet spot. Let's discuss about index funds. Index funds also closely resemble an index like ETF, but the only difference is that these units are not traded on the stock exchange like shares, but instead are managed by mutual fund houses called AMCs. Each unit you buy from the mutual fund house has a value called the net asset value. In the case of index funds, you need not worry about liquidity because you can sell your units, meaning you can redeem your units anytime you wish to. You can also avail the option of SIP. One very important thing is to choose the direct option instead of regular option while buying units of index fund, because direct option cuts down the charges drastically. Make sure your brokerage firm allows for direct option. If it does not allow, you can place your order directly through the website of the mutual fund house. In case of index funds also, you need to look at the tracking error, expense ratio and the history of the fund. The AUM of the index fund you choose should not be too high or too less. Try to choose a moderate AUM. What do we mean by AUM? AUM means assets under management. Just think of AUM as the total pool of funds that the fund house is managing. If the total funds are too high, probably the manager has a tough time managing the funds. On the contrary, if the AUM is too less, it means it has not got enough traction in the market, and funds with too less AUMs may charge you more. Another frequently asked question is, which index should I choose to track? Well, it depends on your risk profile. It is most often suggested to start with an index fund which tracks a broad-based index like Nifty or Sensex. The reason is that these indices are more resilient during times of distress and give you moderate but consistent returns. But a very important point in choosing to invest in an index fund is to stay the course. Just stay invested for long term in order to get moderate and consistent returns without having to worry about the ups and downs of the market.